Something just shifted in the crypto market, and almost nobody caught it. Over the past 90 days, more than $400 billion has quietly drained out of the total crypto market cap. Not from a single crash, not from one headline. It's been slow, steady, and almost invisible. Meanwhile, Bitcoin is still hovering near six figures. Crypto Twitter is still posting rocket emojis. Retail investors are still buying the dip. But underneath the surface, three structural forces are converging. And when they collide, the result is going to reshape who holds wealth in crypto and who loses it. Let's look at what's actually happening. If you hold any crypto right now, even if it's sitting in an exchange account you haven't checked in weeks, this affects you directly. Think about your own position for a second. How much of your net worth is exposed to digital assets? How much of it is in tokens you bought because someone on social media told you it was going to 10x? That's not a judgment. That's a question worth sitting with, because the forces I'm about to walk you through don't care about conviction. They don't care about community. They operate on math. And right now, the math is telling a very specific story. In January of 2018, the total crypto market cap hit $800 billion for the first time. 6 weeks later, it had been cut in half. And by December, it was down 85%. Most people remember that as a bubble popping. But the mechanism that caused it is far more important than the crash itself. It wasn't panic that killed the 2018 market. It was the evaporation of liquidity. Here's what that actually means in plain language. Liquidity is the amount of real money, dollars, euros, yen, that's actively available to buy and sell crypto at any given moment. When liquidity is high, prices stay stable even when people sell. There are enough buyers to absorb the pressure. And when liquidity drains, even small sell orders can move prices violently. The market becomes fragile. Now here's the part that should concern you. Crypto exchange trading volumes have dropped over 40% from their peaks in late 2024. Bitcoin spot volume, the actual buying and selling of real Bitcoin, not derivatives, is at its lowest level in over a year. And stablecoin inflows, which represent new money entering the ecosystem, have been flat or declining for months. The price looks fine, but the foundation underneath it is thinning. And here's where it connects to your money directly. When liquidity dries up, it doesn't matter what your portfolio says on screen. If there aren't enough real buyers when you need to sell, the price you see isn't the price you get. It's a number on a screen, not a guarantee. There's an old Wall Street concept for this. It's called the crowded exit problem. Imagine a theater where everyone has a seat and the show is fine, but there are only two doors. As long as nobody panics, no problem. The moment everyone moves toward those doors at once, the number of seats doesn't matter. It is the size of the exits that determines who gets out. Right now, the crypto theater is full, and the exits are narrower than most people realize. In April of 2025, the European Union's MiCA regulation went into full enforcement. For the first time in crypto's history, a major economic bloc representing 450 million people and roughly 18% of the global GDP imposed comprehensive rules on every crypto exchange, token issuer, and stablecoin provider operating within its borders. That wasn't a warning, that was implementation. And within months, multiple exchanges delisted dozens of tokens that couldn't meet compliance requirements. Stablecoin providers that didn't hold properly audited reserves were forced to shut down or restructure. And the cost of operating a crypto business in Europe effectively doubled overnight. Now, some of you are probably thinking, this is just Europe. The US is going the other direction. Trump's administration is pro-crypto. The regulatory tide is turning. Fair point, and it's partially right. But here's what the optimism misses. Pro-crypto policy doesn't mean no regulation. It means structured regulation, and structured regulation always creates winners and losers. The Genius Act in the US created a legal framework for stablecoins. Yes, but that framework requires every stablecoin issuer to hold reserves in US treasuries or cash equivalents. That's not deregulation. That's integration into the traditional financial system. And integration comes with a cost: compliance infrastructure, audit requirements, reporting obligations. The small and mid-tier projects, the ones that often deliver the biggest returns for retail investors, can't afford that overhead. They get squeezed out. What remains is a market increasingly dominated by the largest players who can absorb the compliance cost. Watch the pattern through history. Every time an emerging financial market gets regulated, the same thing happens. The Wild West phase ends. Consolidation begins. Small players disappear and big players get bigger. The returns shift from explosive to institutional. The 1930 securities regulations did this to stocks. Post-2008, Dodd-Frank did this to banking. Now MICA and the Genius Act are doing it to crypto. But that doesn't mean crypto dies. It means the version of crypto that most retail investors fell in love with, permissionless, unregulated, high upside chaos, is being methodically replaced by something that looks a lot more like traditional finance wearing a blockchain costume. This is your money being affected right now. And if your portfolio is heavy in smaller altcoins or tokens tied to unregulated platforms, the regulatory squeeze isn't coming. It's already here. On November 8, 2022, the crypto market woke up to discover that FTX, at the time the third largest exchange on the planet, valued at $32 billion, was insolvent. Within 72 hours, it was bankrupt. Customers lost over $8 billion. The entire crypto market dropped 30% in a week. The lesson everyone took from that was, don't trust centralized exchanges. Move your crypto to self-custody. Demand proof of reserves. That lesson was real, but it was incomplete, because the actual force that destroyed FTX wasn't fraud alone. It was leverage. Sam Bankman-Fried, the founder who was later convicted of fraud, had built an empire where customer deposits were used as collateral for leverage bets. And when those bets went wrong, there was nothing backing the deposits. The leverage amplified a manageable problem into a catastrophic one. Now here's what the data shows about where we stand today. Open interest in Bitcoin futures, which measures the total value of outstanding leverage bets, has been climbing steadily throughout 2025. It recently crossed the $70 billion mark. That's comparable to levels seen right before the FTX collapse and the 2021 peak. The funding rates on perpetual futures contracts, a technical measure of how much traders are paying to maintain leveraged long positions, have been persistently elevated. In simple terms, that means a lot of people are borrowing money to bet that crypto goes up. I genuinely prefer to tell you this metric looks healthy. Well, it doesn't. When this much borrowed money is stacked on one side of a trade, it creates a mechanical vulnerability. If the price drops even 5 to 10%, leverage positions get liquidated. Those liquidations create more selling. That selling triggers more liquidations. It's a self-reinforcing spiral that has played out in crypto at least 6 times since 2017. And here's where all three forces connect. Thin liquidity from Force 1 means there aren't enough buyers to absorb the selling. Regulatory pressure from Force 2 means fewer participants and less capital entering the market. And elevated leverage from Force 3 means the trigger for a cascade does not need to be dramatic. A mid-sized exchange delisting, an unexpected regulatory announcement, a single large fund unwinding a position. The combination is what makes this fragile, not any one force by itself. If you've been watching this channel, you know we track these cycles in phases. Here's where crypto sits right now. Phase 1. Complacency. Prices hold steady or drift upward. Headlines stay positive. Social media sentiment is optimistic. Most investors assume the worst is behind them. The warning signs are in the data, but the data does not make headlines. And by the time you've watched this far, you already understand more about these structural forces than the vast majority of crypto investors. That's not flattery. That's the reality of how attention works in this market. Phase 2. Fracture. The first visible crack appears. Maybe a mid-tier exchange halts withdrawals. Maybe a major stablecoin briefly loses its peg. Maybe a leverage fund blows up. Sentiment shifts from confident to cautious. Volume spikes on the sell side. This is when most people start paying attention, and by then, the best window to act has already narrowed. Phase 3. Cascade. Liquidations feed selling. Selling feeds liquidations. Prices drop 20, 30, 40% in days, not months. Crypto Twitter goes silent. The people who were posting diamond hands emojis last week are now asking how to file tax losses. And just like every previous cycle, this is when fortunes get built by the people who prepared while others panicked. We are in late phase 1 right now. The complacency is thick. The structural cracks are visible if you look at the data. But most people aren't looking at the data. They're looking at the price. And the price is the last thing to move. Here's what this looks like practically. And I want to be specific, because vague advice does not help no one. If you're early in your investing journey and most of your crypto is in a handful of altcoins, audit your portfolio tonight. Write down every position. Ask yourself one question for each. If this token dropped 60% tomorrow and stayed there for 2 years, would I still believe in the project? If the answer is no, or if the answer is, I don't know enough to say, that's your signal to reduce exposure. Not to zero necessarily, but to a level where a crash does not change your life. If you hold significant crypto positions and you're already profitable, consider taking partial profits into stable assets. Not because the top is definitely in, but because securing gains you've already earned is the only guaranteed way to keep them. There is a concept called the endowment effect. We overvalue things simply because we own them. Your Bitcoin doesn't know you own it. It doesn't owe you anything. Locking in some profit isn't paper handing, it's risk management. Now, if you're sitting in cash and waiting to enter crypto, you might be in the most powerful position of all. Every cycle that cracks open creates entry points that look obvious in hindsight but feel terrifying in real time. In December 2018, Bitcoin was under $4,000. In June of 2022, it was under $18,000. Both felt like the end of crypto. Both turned out to be generational buying opportunities. Build your watch list now. Decide your entry prices in advance. Write them down. Because when phase 3 hits, your emotions will tell you to stay away. Your plan needs to be louder than your fear. Let me leave you with one number that puts all of this in perspective. After the 2022 crypto crash, Bitcoin bottomed at around $15,500. If you'd put $10,000 into Bitcoin at that low point, by early 2025, barely even 2 years later, that position was worth roughly $65,000. Not because you were lucky, not because you had insider information, but because you understood that crises don't destroy value in crypto, they reprice it. And the people who were positioned with cash, with a plan, with the psychological training to act when everyone else froze, they captured that repricing. The same setup is forming again. Different details, same structure, same human psychology, and same opportunity. I don't say that to create panic. I say it because I'd rather you hear this now while you still have the luxury of time than hear it after phase 3 when the only options left are bad ones. Do one thing tonight. Open your crypto portfolio, write down every position, the percentage of your net worth it represents. If that number makes you uncomfortable, you have your answer. Drop a comment and tell me, are you in accumulation mode, holding mode, or exit mode right now? I want to know where you stand. And if this helped you see something you weren't seeing before, hit subscribe. We track these patterns every week. And when phase 2 triggers, you'll want to know the moment it happens. None of this is personal financial advice. This is education. so you can build your own plan and make decisions that fit your situation. Now you see the pattern. The only question is what you do with it.